Tell me a little bit more about industrial
Sure.
warehouse that you help people to get those kind of properties.
100%. So the couple of years ago, like I said, I was in residential real estate and read the book and changed my perspective. And I'll tell you how I got into my first one, and then it just kind of snowballs. But 70,000 square feet in Tarrant, Alabama, which is like northeast Birmingham. I knew that I wanted to make a change. I knew I was buying $40,000 houses, and I was like, this is cool. But what if I added a couple more zeros to a transaction? I was just afraid. I had fear because of the unknown, right? And so the opportunity presented itself. I had a wholesaler at the time, not even a broker, send this deal to me. And 11 and a half cap rate, triple net lease, the whole thing. Pretty good deal. And 1.35 million in Birmingham. I had to show up with $350,000 for the down payment, which again, as you know, like that's just in real estate in general, you got to show up with a down payment. And this when we went and sat down with the seller, who's actually a friend of mine now, we've done a couple other deals since. He's like, hey, I'd like to leave $500,000 in this deal. He used that vocabulary.
Mhm.
And I was like, okay, all right. And I didn't agree or disagree to it. But I called my accountant afterward and I said, what can you educate me? Because again, I'm new to this commercial thing. I just knew I had to do something different. And I said, can you educate me on what he means by leaving money in this deal?
Mhm.
And my guy Clay Hagler is in Birmingham. Great account. If any of your listeners need him, he is awesome. Hagler and Brocado on Valleydale in Birmingham. He goes, Nolan, it's just a tax move. He's separating his capital gains into two separate years. It's very simple. And I said, interesting. So I said, so you're telling me that all I got to do, and what that means essentially is that I'm borrowing 900,000. It was like $850,000 from the local bank, and then he was financing me the down payment of $500,000 in the form of a second position mortgage and not receiving that at closing instead of me having to show up with that capital and send that to the title company. He's like, you just nailed it. That's it. That's it. And he's just separating into two separate years to lower his capital gains tax. Plus, I pay him an interest rate because it's debt. And I was like, interesting, interesting. Okay. So he's the one that's initial seller introduced me to this strategy of like second position more. I didn't even know what a lien was when I was first getting started.
Mhm.
And um, and then we go buy another building, and then we go raise some capital from some investors. And there's a couple ways that I do this, and maybe you do this too with your investors, Raja. But what I like to do is I offer two easy solutions. Usually, when I sit down on $1 million building, I've got a couple relationships with banks. Let's say 750 from the bank. I got to show up with $250,000 for the down payment. I'll either have the seller leave money in the deal. There's a three windows, I guess. Have the seller leave money in the deal. It's usually a no-brainer for them because I educate them on the whole reason why it's important to separate capital gains, the whole thing. I try and focus myself as a seller consultant. I don't show up as like a buyer. I try and let the seller know, hey, look, I you're in the steel fabrication business, you're in glass supply. I'm in the real estate business. This is what I do for a living. Let me show you how to lower your taxable income down to as minimum as possible. And I become a seller consultant. So when I sit down with them and they tell me about their capital gains problem, that's when I slow down and I say, John, Raja, I'd like to offer you an opportunity. And I say it like that. And they're immediately curious. And that's when I say, I'd like to offer you the opportunity to leave money in this deal. And I kind of say it very casually, but with confidence. And they're immediately curious. It like changes the perspective and kind of the whole like tone of the conversation. Before I was trying to get to know them, and then I'm down to business. And it kind of jolts them a little bit, but then they're intrigued. And then I say, look, here's my one pager. I have this one pager showing like the taxes, what it would take if we just brought the money to the deal. If they left money in the deal, this is how much they would save. And then I flip the page over, I whip my Sharpie out, and I say, you leave 250 in the deal, you multiply that by 0.06, that's $20,000 a year, divide that by 12, I'm paying you 1,750 bucks a month. And I kind of make it very, very simple. This side's for your accountant, flip it over, this side's for you. So that's kind of the first way that I offer that. And 9 times out of 10, it works. I mean, they're calling their account like that after they're usually asking if they can leave more money in the deal. This, you know, the second option is sometimes when the seller is in a trust or just doesn't have the ability to make the decision. They're kind of handcuffed, and they say, "Look, we just can't leave money in the deal," even though the tax move does. I mean, happens before where someone's wife was like, "Look, I'm going to the beach. If you don't do this the way that I want, even if we're making less money, which is not uncommon, um, then I'm just, I'm going to sell or whatever." So then I'll raise the money with an investor. And the way that I offer, so let's say you and I went into business on that same $1 million deal. I would offer you to bring the $250,000 in capital as a down payment. And let's say the net cash flow was 50 grand a year or whatever. I would offer you to earn 100% of the cash flow, but we split the equity 50-50. And the reason why that is you make all the money in cash flow, you're more likely a much higher earner than I am. I need the depreciation deduction to offset against my other income, because the cash flow is just simply the cherry on top to me. Every deal's got to be bankable. You got to make sure you got the right debt ratios, the right cap rates, the right cash flow. But I look at it from a tax perspective. That's the only thing that truly matters to me is the taxes. So that's the second option. And the third option, of course, is, and I've only done this like a couple of times, um, depending upon the upside of the deal. And I did this actually like a year and a half ago, where I bought a building for 300,000 bucks, borrowed 75% from a bank, and then I had another investor who was a dentist that just didn't have any appetite for investment, right? You have two levers, right? If you're an investor, you participate in the upside, but you also participate in the downside, right? The banks or lenders, they just want something consistent and they don't want to participate in risk, right? They're risk adverse. And this dentist was like, "Look, dude, if you can give me 10% on my money, I don't really care about ownership. I don't care about the tax benefits. I truly just want some type of stream of income," right? So I was like, "Interesting. How about this, guy? Doc, you lend me 90,000 bucks. You're in a second position behind my bank, but I'm guaranteeing you $9,000 every year for the next 2 years or 3 years, or whatever it was, 2 years. And then I'll balloon you back out the $90,000." And I knew that I had upside on this building, and actually we just refinanced it back in November. But I bought it for 300,000. We did a couple of things to it. It just appraised for like 620,000 bucks or something. And so I just pulled out roughly 450 or whatever, like 70% loan to value, paid off my first mortgage. I paid off my second mortgage, which was my dentist lender. And
Mhm.
I still own 100% of that. I still have 100% equity in that building versus dishing off 50% equity to another investor who might have appetite for risk. So I think at the end of the day, that's a very, very roundabout way of getting there. But essentially having the seller leave money in the deal, partnering with another investor that has risk appetite, or partnering with a higher income earner that doesn't have risk appetite but just wants a return. And that's kind of the three-pronged system that I kind of go off of when every single deal that comes into my pipeline.
That's great.